Then the series of standards, we are discussing the summary of all the accounting standards. After IAS 28, the next standard was IAS 31, which is merged with IAS 28 now, and we reach IAS 32, that is presentation of financial instruments. Now IAS 32 is not alone, and it has a relationship with IFRS 9 and IFRS 7 disclosures. So IFRS 9 is the standard which replaced IAS 39, financial instruments, recognition and measurement. So we'll be discussing all the three standards together. Now, as far as financial instruments are concerned, it means that it is an asset of one entity and liability of another. And financial instrument will be either a financial asset or a financial liability. If it is a financial asset, it is divided into two parts: debt financial instruments and equity financial instruments. Debt financial instruments are measured on the basis of the business model of the entity. Now, depending on the business model of the entity, whether the business model is to receive contractually related cash flows and solely payments of principal and interest, and they intend to hold the asset till maturity. If they intend to hold the asset till maturity, this will be measured on the basis of amortized cost. The example is a loan receivable. Now, if their intention is to receive solely, this is also known as SPPI test, and solely payments of principal and interest and contractually agreed cash flows, they'll be recording the asset at amortized cost. Financial instruments are measured either at amortized cost or either at fair value. Depending on the business model, we decide whether we'll be recording them at amortized cost or at fair value. The second category is they intend to receive solely payments of principal interest and contractually agreed cash flows, but they say that they may sell this asset in the middle. They may not hold it till maturity. Their intention is to sell this asset. If they face liquidity problems, they may sell this asset. Now, IFRS 9 financial instrument says that if this is the situation, then they need to mandatorily recognize this asset at fair value through OCI. They cannot measure it at amortized cost. If they measure it at fair value through OCI, then it will be shown as part of equity components, and this is one of the items which is classified to P&L on settlement, because this is a mandatory recognizable debt instrument which is supposed to be measured at fair value through OCI. The third category, if it is a debt instrument which you are holding for trading, you can show it as part of fair value through P&L. Now, at the end of each year, you are required to remeasure and take the difference to P&L. In case of the second category, which you may intend to sell, that is debt instrument which you are holding for, the second category of debt instrument which you are not intending to hold till maturity, but you're going to receive contractually agreed cash flows and meeting the SPPI category, will be mandatorily recognized as fair value through OCI. Means this is also going to be remeasured at the end of each year, but the difference will be taken to OCI. The second type of financial asset is a equity instrument. They are never measured at amortized cost. So the only option available with us is that they are measured at fair value through P&L. Whether held for trading or not, we measure them at fair value through P&L. Now, but if you intend to hold any equity instrument for a longer period of time, you have an irrevocable option that you can measure them at fair value through OCI. The equity instruments which you plan to hold for a longer period of time, you have an option that you can measure them at fair value through OCI. Irrevocable option means they can never be reclassified to P&L. Now, this was one of the components we discussed in our previous discussion, that the items which are never reclassified to P&L, one of the item is an equity instrument which is designated at fair value through OCI. Even on settlement, even if you sell it in future, though you plan to hold it for a longer period of time, you take the difference to OCI, and even if you settle it someday, if you sell it, it will be directly routed to equity, never reclassified to P&L. Financial liabilities are measured at amortized cost or at fair value, but you have an option that the financial liabilities which are measured at amortized cost, you have an option that you can measure them at fair value through P&L. And if there is an accounting mismatch, if you decide to designate them at fair value through P&L, and if there is an accounting mismatch, now this fair value difference may result in some credit risk and some market risk. So you can record the credit risk portion as part of OCI and the remaining as part of P&L. But if this enlarges an accounting mismatch, you still have a choice that you can record it directly as part of fair value through P&L. So financial liabilities are measured at either at amortized cost or either at fair value through P&L. Now, financial assets are subject to impairment. Now, anything which is being measured at fair value is subject to automatic impairment because the difference is being routed through P&L at the end of each year. But if something is measured at amortized cost, but if you notice in the second example, first case is measured at amortized cost, this is subject to impairment. Second case, it is being measured at fair value through OCI, but the amount we are going to receive is solely payments of principal, interest and contractually agreed cash flows. So there can be a doubt on the recoverability of this asset, because the recoverability is not on the basis of fair value. The measurement is on the basis of fair value through OCI, but the recoverability is on the basis of contractually agreed cash flows, solely payment of principal, interest. There can be a doubt on the recoverability. Now, as far as impairment is concerned, now this portion, let me discuss this first. That if there is any presentation for loss allowance relating to debt instrument measured at fair value through OCI, if there is any loss allowance for debt instruments measured at OCI, the second case, so the portion in the fall in fair value relating to credit losses will be charged to P&L directly. So we are not creating allowance for this category. If there is any debt instrument which is measured at fair value through OCI, this is being measured at fair value at the end of each year. So there will be some difference, there will be either gain or there will be either loss. If there is a loss, now out of that total loss, how much is the loss relating to credit loss? That will be taking directly to P&L. Remaining will be showing as part of OCI. Because we are measuring it at fair value through OCI, we are supposed to take the difference entirely to fair value through OCI. But if there is a credit loss relating to it, that credit loss should be shown as part of P&L. Any remaining balance we can show as part of OCI. So the remainder being recognized in OCI, no allowance account is needed because the financial asset is already carried at fair value. So with the exception of the instruments measured at fair value to OCI, for all other debt instruments, depending on their stage, we create a loss allowance and any fall will be set off through that loss allowance. So fair value through OCI item, we do not create any allowance. If there is any difference, we'll be taking directly to the credit losses will be taken directly to P&L, the other difference will be taken to OCI. Here is a debt instrument which is measured at 6,000 initially, and later on at the end of the year, the instrument was quoted to have a market value of 5,300. Means there is a fall of 700. We need to see that how much of this fall relates to credit losses and how much of this fall is the change in market value. So we got to know that the expected credit loss for this is 400. So that means 400 will be charged directly to P&L and remaining balance will be shown as part of OCI. Total fall is 700. Out of 700, 400 is forming part of P&L and 300 will be forming part of fair value through OCI. This is the accounting relating to impairment of the debt instruments which are designated at fair value through OCI. They are being measured at fair value at the end of each year, but their difference is being directed to OCI. But there can be a doubt on the recoverability of that asset because they are contractually agreed cash flows and solely payments of principal interest. So be careful while dealing with it. Now impairment will be applicable only on the debt instruments which are being measured at amortized cost. Equity instruments are never measured at amortized cost. So debt instruments which are being measured at amortized cost. Second case we have already dealt with. Third case is already being measured at fair value through P&L. Automatic impairment happening. The difference gain or loss is being recorded directly into P&L. So these debt instruments which are at amortized cost are subject to impairment. The first item which comes into this category is the trade receivables. Now in case of trade receivables, there is a doubt on the recoverability of the asset. So we may not record those trade receivables at the amount at which they are being shown. They may be subject to impairment. Now for the case of trade receivables, we'll be looking at their lifetime expected losses. Lifetime expected losses purposely because this is a current item which is going to be settled within 1 year or more than that if you extended that period. So trade receivables are normally going to be settled within 1 year. So is the reason we test for lifetime expected losses model on it. So depending on the risk involved, expected credit loss model. Now this is moving on from incurred loss model to expected credit loss model. Depending on the type of risk, if it is a less risky investment, that means we are in stage 1. And if we are in stage 1, we'll create an allowance for the expected loss on this asset, on the recoverability of the asset for the 12-month period. If it is a less risky investment, then we expect the loss for the 1-year period and we create an allowance for the 12-month expected losses. And we continue to record interest on the gross carrying amount of the asset. Whatever interest we are expecting on this investment, we continue to record it on gross carrying amount and this asset is not considered impairment. But if there is if this recoverability or if the amount we are supposed to receive is 30 days past due, if it is 30 days past due, it moves from less risky investment to a risky investment. We continue to create an allowance on the basis of now this has moved from 12-month expected losses to lifetime expected losses. Lifetime expected losses means this investment or if the maturity period is 10 years, how much loss we can expect over 10-year period. what is the doubt on the recoverability of the asset over 10-year period, what is the expected losses over 10-year period. We create an allowance on the basis of expected losses over a 10-year period, but even in this case the asset is not yet impaired. We continue to record the interest income on the basis of cross carrying amount. Asset is not yet impaired. Third category is when the stage is when asset is risky, actually got impaired. There is a doubt on the recoverability of the asset, we are charging impairment. So we use the allowance which we have created till now. We were creating an allowance when the asset was in stage 1 and stage 2. We were creating an allowance, we'll use this allowance, we'll debit that allowance. We have already been charging those expected losses as part of P&L in stage 1 and stage 2. In stage 3's case, we are using this allowance to set it off against the asset. Now the asset got impaired. Now the new interest will be charged on the net carrying amount. The asset has reached impairment. So this is how we'll deal with expected credit loss model, and hope you are aware how we are going to deal with the debt instrument related to fair value through OCI. If there is any fall in the fair value through OCI item which is mandatorily recognized because of being a debt instrument and because we intend to sell it, any credit losses will be forming as part of P&L, but anything above and beyond that amount change in fair value will be forming as part of OCI. Now, when we are dealing with financial instruments, we also deal with hedge accounting. Hedge accounting is voluntary. So we apply hedge accounting only if we wish to, only if we believe that the economic relationships are matching and it is meeting those hedge accounting relationships. Hedge accounting is voluntary. If we decide to get into this, we go for hedge accounting. Otherwise, our forward contracts or future contracts are considered normal items, either recording as financial assets or financial liabilities, depending on their position on each balance sheet date. Hedge accounting is possible only if the hedged item and hedging instrument have economic relationship. That is, gain on one side exactly compensates the loss on the other side. If this is the case, then there is a hedging relationship. Now the intention is to minimize the exposure of risk. We may not eliminate the exposure of risk, but we can minimize the exposure of risk using hedge accounting. For hedge accounting, we need to compare the change in value of an asset with the change in the value of the contract. Now the hedged item's value, if there is any change, hedged item can be a currency, hedged item can be an item it can be a change in the fair value of an item or change in the cash flow related to that item. Hedged item, if there is any change in the value of the asset, we compare it with the hedging instrument, change in the value of the forward contract or future contract which we have taken in the form of a hedging instrument to minimize the exposure of risk. Now hedge accounting can be done for minimizing the fair value risk, for cash flow risk, and for any change in the total value of net investment in a foreign operation. Net investment in a foreign operation and cash flow hedge are dealt with in the same manner. Fair value hedge is treated differently. Any change in fair value hedge, when we compare the value of an asset with the change in the value of an hedging instrument, any change in case of a fair value hedge is rightly shown as part of P&L. But in case of a cash flow hedge, we see whether the hedging is effective or ineffective. Depending on the effectiveness of the hedge, we decide how much portion will go to P&L and how much portion will go to OCI. If we do not account using hedge accounting, we treat it as a normal contractual agreement, normal financial assets or liabilities. But if we use hedge accounting, we need to take the difference to P&L or OCI depending on the effectiveness of the hedge. The effective portion of the hedge will be taken to OCI. The ineffective portion, as I said, the management was not capable to identify a true hedging instrument. The ineffective portion will be shown as part of P&L. On settlement, the amount in OCI will be reclassified to P&L. If you look at the items of OCI, among them there was a cash flow hedge item which may be reclassified to P&L on settlement. So if the hedging instrument is able to, how much is effective and not effective, we'll get to know. If the hedging instrument is able to set off the gain or loss up to the value of hedged item, up to the value of hedged item is effective, anything beyond it is considered ineffective. Up to the value of hedged item, if there is any gain or loss, that will be considered effective, shown as part of OCI. Now in this example, if you notice, there is a gain on forward contract which is 83,87,096. There is increase in value of an asset which is 86,20,000. Now up to the value of the hedged item, up to the value of hedged item means up to 86,000, up to 86,20,690, it can be considered effective. Up to the gain or loss on the hedged item can be considered effective. So this is effective till 8387. So any gain on forward contract is effective till up to this item. That means till 86,026.90 it could be effective. So we reached the gain of 83,87,000. So this is effective portion to be shown as part of OCI. If there is a gain on forward contract which is 11,61,000, which is 1 crore 16 lakh 12,904. 1 crore 16 lakh 12,904 is the total gain. But what is the gain or loss on the hedged item? The loss on the hedged item is 1 crore. So that means up to this value was considered effective. Anything beyond it will be considered non-effective. So that means 1 crore will be shown as part of OCI, and anything beyond it will be shown as part of P&L. This is how we deal with hedge accounting, and I come to the conclusion of the financial instruments. The next standard is IAS 33, earnings per share. The earnings per share is shown with equal prominence. It is shown for continuing operations, it is shown for continued plus discontinued operations. We show basic EPS, and we are also required to show diluted EPS. Diluted EPS means that if we assume that what if all the potential ordinary shares means which has the potential to get converted into ordinary shares, what if they get converted into ordinary shares? What will be the impact on the earnings per share of the individuals in future? So we present basic EPS, and basic EPS is calculated on the basis of the earnings of the year, and we divide it with the weighted average number of shares outstanding by the end of the year. Weighted average number of shares outstanding means that if there were 100,000 shares in issue at the beginning of the year, and there were 20,000 shares issued in March or July, and there was a treasury there was a buyback of shares in October, what is the total number of shares outstanding during the year? There were 100,000 at the beginning of the year, we issued 20,000, they reached 120, there was a buyback of 30, that means for 3 months there were 90,000 shares. So the average outstanding weighted average number of shares is used as a denominator to calculate the basic EPS. Now, depending on whether there is a bonus issue or rights issue, if there is a bonus issue, we believe that the bonus issue has taken place at the beginning of the previous year, because we need to make an adjustment to the comparative amount of EPS as well. We are presenting current year EPS, we need to adjust the comparative EPS as well. Now, for making it possible, we believe that if there is a bonus issue, it takes place at the beginning of the previous year. Same is the principle applied for rights issue. Now, if rights issue has happened in the middle of the year, we believe that the portion relating to rights issue, which is coming in without money. Now, rights issue is at a lower price than in the market. That means someone who is opting for rights issue shares, they are paying resources to the firm, but there is a portion which is bonus within the rights issue, which is coming in without any resources, which is not benefiting the firm in terms of resources. So since this is being issued at a lower price than in the market, so that the portion which is coming in without money is a bonus portion. So we treat it in the same manner that when we are dealing with a rights issue, for the denominator to be used in the calculation of rights issue number of shares, for the period before the rights issue, we calculate the bonus number of shares as well. Now we calculate the average price of shares. The average price of shares means if the market price of a share is 6, but the average price to us, since we own these shares, is 5. We assume, what if we would have owned these shares which were existing at the end of the previous year? What if we would have got those shares at an average price? How many more shares could have been issued? So when we make the adjustment for the previous year, what we do? We divide the previous year EPS and the previous number of shares. If 100,000 shares were in issue at the end of previous year, we assume that the market price today is 6 per share. That means total value of those shares is 600,000, and total value of those shares is 600,000. But if the average price to us is 5, how many more shares we could have purchased? So this could have turned to 120,000 shares. So this 20,000 shares extra is considered bonus in a rights issue. So when we are adjusting the previous year EPS, either we can adjust the denominator was 100,000, we can adjust it like this: 100,000 multiply with the fair value of the share, number of shares outstanding 100,000, multiply with the fair value of the share, that is 6 per share. If the total value of shares according to today's market terms is 6 lakh, but the average price to us is 5, how many shares could have been issued? That is 120,000. If we use this new denominator and apply it to the previous year's openings, we'll be able to adjust the previous year EPS. So we have a choice that either we use it in the denominator directly, number of shares outstanding, multiply with the fair value 6, divide with the 5, we get the denominator adjusted, and we use the earnings of the previous year to adjust the previous year EPS. The other option is we can take the inverse fraction. directly applying it to the previous year EPS. The inverse fraction will be, we were multiplying it with the fair value 6 and then trying to know what if we were given shares at a price of 5, how many shares could have been bought. But this denominator, if we inverse the fraction, we can directly apply it to the previous year EPS. So if you are adjusting the previous year EPS, make sure whether you are applying the fraction to the recalculation of previous year EPS or directly to the previous year EPS. Be careful. If you are applying it to the directly to the previous year EPS, use the inverse fraction. But if you are recalculating the previous year EPS, use it in the denominator number of shares, so you'll be not committing a mistake. Now this is being done for the previous year adjustment. Now what if there is a rights issue during the year? Now during the year, if there is a rights issue, means there is a period before the rights issue, there is a period after the rights issue. So the previous period before the rights issue needs to be adjusted like we adjusted the previous year. We adjusted the previous year EPS. So are we required to adjust the period before the rights issue for this bonus element? So what we do, number of shares immediately before rights issue, we multiply with the fraction of the months before the rights issue, and we multiply with the same fraction which we use for previous year EPS adjustment. That what if the fair value of these shares in the market is 6 and if we are getting it for a price of 5, how many more shares we could have bought? So we adjust the number of shares immediately before the rights issue with these fractions of fair value and weighted average plus number of shares after the rights issue, we all know, has increased in number and they remain for the remaining part of the year. So number of shares after the rights issue into fraction of months after the rights issue, this is the total number to be used as denominator for calculating the EPS in case of a rights issue. For bonus issue, we assume as if it has happened at the beginning of the previous year, so no issues. For a rights issue, there is a bonus element for some portion of the year. That is for the period before the rights issue and the previous year there is a bonus element. Because after the rights issue, the number of shares have increased. So we eliminate the bonus part in the previous years and include it or increase the number of shares, include it as part of the EPS calculation for a rights issue. This is how we deal with bonus issue and rights issue. Now when we move on to deal with diluted EPS. Now diluted EPS is a imaginary figure believing that what if all the shares get converted today on the last day of the reporting date, what if they all get converted? What will be the impact on the earnings? We assume all the potential shares are converted and we assume the worst situation. So what will happen? Whatever is the earning being used in the basic EPS calculation will plus. Now if we were paying interest till now, we will not be required to pay interest if they are converted into ordinary shares. If we are not paying back interest, that increases our income. If it increases our income, there is a tax applicable on it. And if there is a tax applicable on it, we'll take the after tax impact in the form of earnings. We'll increase the earnings, but we'll take into account the tax impact of it. The number of shares which we use for basic EPS calculation and number of shares which get converted because of this expected dilution will be the denominator. But this diluted EPS will be calculated only for dilutive circumstances, will not be including anti-dilutive circumstances. Now, if there is any potential conversion of shares in future results in increase in earnings per share, that will not be forming part of calculation of diluted EPS. Will only take into account dilutive circumstances to calculate diluted EPS. If there are share options being issued, now if there are share options, now share options are being issued at a lower price. So we assume that what if we would have issued at the lower price, how much money we would have got? Now if we would have got 1200,000 and we issued at a lower price in the market, what number of shares we would have issued? Now if we have issued 200,000 shares and 150,000 shares we issued at a lower price, that means 50,000 we issued for free. So in case of share options, we assume that how many shares have been issued at par with the fair value in the market and how many shares are issued at for free. So the shares which are issued at for free are included as part of the denominator to calculate the diluted EPS. So this is how we deal with IAS 33 earnings per share. So next standard is IAS 34. IAS 34 is a standard which is applicable only if an entity uses or produces interim reports, whether 6 monthly or whether quarterly. Now, if they are producing interim reports, they are required to follow the principles of IAS 34 interim reporting, which says that you have a choice that when you are presenting your interim reports, you have a choice that you will present condensed set of financial statements or you can present full set of financial statements. If you are presenting full set of financial statements, you need to abide by the principles of IAS 1 presentation of financial statements. But if you are using condensed set of financial statements, you can follow the principles of IAS 34. It says that if you are presenting your balance sheet, you need to present your interim balance sheet Now, along with the interim balance sheet, for comparative, you need to present the most recent annual financial statement published. Now, if the balance sheet of 30th September 15 is presented as a current year balance sheet, for comparative, the most recent annual financial statement is published. If anyone is willing to publish 31st March, if anyone is willing to publish 30th September 14 balance sheet, they can do so, but that is not a requirement. So the minimum requirement is that current year balance sheet is of 30th September, the comparative balance sheet is of 31st March, which is the most recent annual financial statement published. If you wish to publish 30th September 14 balance sheet, no one stops you. That's the requirement for the balance sheet. As far as income statement is concerned, the income statement is belonging to a period. Now the period runs from the beginning of the financial year till the end of the reporting period. Now if we are in the second interim period, the current interim period will begin from 1st July to 30th September, but the cumulative year to date period will be beginning from 1st April to 30th September. So for your income statement, you'll be presenting, since it belongs to the period, you'll be presenting the current period and you'll also be presenting the comparative period. In similar fashion, since it takes into account the seasonality and cyclicality of operations. So for the current period, since it takes into account the seasons and the cycles of operations, that in a different season you generate more revenue, in winters you generate more revenue, in summers you generate less revenue. You're comparing it exactly with the period in which those operations happened. So you compare the current period 1st July 15 to 30th September 15 with 1st July 14 to 30th September 14, and comparative period, the cumulative year to date period from 1st April to 30th September 15 will be compared with 1st April 14 to 30th September 14. So that's the requirement for the income statement. For changes in cash flows and changes in equity, they don't belong to a period, but so we'll be presenting the changes in equity and cash flows belong to the period. The cash flows earned or generated during that period are presented in year to date basis. So we do not need to define them in terms of what is the current cash flow or what is the current status of changes in equity. We can know their progress, what was the position at the beginning of the year, what is the cash flow generated during this period. So we'll be presenting year to date only, will not be dividing it to current and cumulative. Current and cumulative will only be done only for the statement of income. That will be dividing into current and cumulative year to date basis. For changes in equity and cash flows, we'll present year to date statements. That if the year, even if it is second interim period, year to date begins from 1st April to 30th September, will be cumulative year to date, and comparative will be of the previous year for cash flow and changes in equity. This is how the presentation of financial statements is done for interim period. And for the notes to accounts, there are some selected explanatory notes. We do not need to undergo the same full exercise as we go for annual financial statements published. We can extrapolate, we can make some approximations, and we can present financial statements by only presenting those selected explanatory notes. This is all for IAS 34. The next standard is IAS 36, impairment of assets. Now, as the name suggests, impairment is applicable to the assets which are carried at cost, because the assets which are carried at fair value are subject to automatic impairment at the end of each year, and they are revised at the end of each year. So the assets which are carried at cost are subject to impairment, and we test the carrying value in comparison to their recoverable amount. Now why we do so? Because there are only two ways of recovering the value of an asset, either by using it or either by selling it. So whichever is higher will give you the sense of business, that whichever is giving you more value, whether by selling it or whether by using it, you stick to it. You'll not be emotional about the values of assets. You'll be taking business decisions, which says that the higher value is actually the sensible value which you can use. If using it gives you more value, continue to use. If selling it gives you more value, better sell it and recover the value, because that the higher of the two is actually the recoverable amount. So when we compare it with the carrying amount, if carrying amount is lower than the recoverable amount, or if carrying amount is higher than the recoverable amount, if carrying amount is higher than the recoverable amount, it is subject to impairment. We cannot justify that the value at which it is being shown in the financial statements, if we are not able to recover, we should charge impairment. But if the carrying amount is lower and recoverability is higher, so IFRS is very conservative as far as profitability is concerned. So if it is carrying amount is lower, we do nothing. There is no impairment. Now this impairment can be for an individual asset, can be for a CGU. Individual asset, we compare the carrying amount with the recoverable amount. For a CGU, we need to know the recoverability of the CGU. CGU is the smallest identifiable group of assets which together form cash flows, which cannot be identified separately, individually. So, and these CGUs may be with goodwill, without goodwill, because if there is a business combination, if one company has acquired another company, there is a goodwill purchased as well. that goodwill is also allocated to all the CGUs which benefit from the synergies of the business combination. So CGU can be with goodwill, CGUs can be without goodwill. Now depending on what is the status, if there is a CGU with goodwill and if there is any impairment in a CGU, first we'll remove the goodwill. So first thing is to be done is we can reduce the goodwill to 0. The second case is if we know specifically that an asset which specifically got impaired. So in that scenario, we can directly reduce the value of the asset which got specifically impaired. And in all other cases, we'll apply the impairment loss on pro rata basis because we cannot specifically identify the loss to one of the assets. We'll apply the impact on pro rata basis to all the assets which form part of the CGU. So the hierarchy will be, first, if you know any asset which is specifically impaired, please impair that. If there is no such asset which you can identify, then first you need to impair goodwill. Until goodwill gets reduced to 0, you cannot charge the remaining loss on pro rata basis. If you have reduced down the goodwill to 0, remaining loss you can charge it on pro rata basis. But if you charge the loss to goodwill and still goodwill remains, then other assets do not get impacted because of the impairment loss. If there is no goodwill, the only option left to you is see if there is any asset which is specifically impaired, impair that asset, and remaining charge all other assets on pro rata basis the amount of impairment loss. Reversal of goodwill is not allowed because when we say that reversal, there is a reversal in goodwill which has happened, which means that it is internally generated goodwill, and internally generated goodwill has no meaning. Internally generated goodwill, circular, masthead has no meaning. Only purchased goodwill gets recognized. Now, impairment for the assets under revaluation model. The revaluation model is automatically capable of taking care of the impairment, any fall or gain. So the revaluation model, if there is any fall in the value of an asset and if there is a reserve, we charge first the loss to revaluation reserve, any excess we charge to P&L. If first time revaluation there is a fall, we charge the entire balance to P&L. So the revaluation model of IAS 16 property, plant and equipment is automatically capable of taking care of impairment. Is the reason IAS 36 impairment of assets is not directly applicable to it. This is all about impairment of assets under IAS 36. The next standard is IAS 37. Now, IAS 37 is a standard dealing with provisions, contingent liabilities, and contingent assets. Now, what is a provision? Provision is a liability with an uncertain timing or an uncertain amount. We know one of the things. We know either the amount to be paid or either we know the timing to be paid, but amount is uncertain. Liability is something which you know the amount and you know the time to pay. It is certain time, a certain amount to be paid at a certain time is a liability, which can be clearly shown as part of your balance sheet. But provision is kind of a liability, but it is with an uncertain timing or an amount. You cannot ignore by not recognizing it immediately or not recording it, because that will mean that your financial statements are not giving a true and fair view. So at least you give a close approximation of what is going to be the liability which you are going to pay. If there is any difference, that will be a revision in the estimates of provisions. Contingent is something which you are not aware how much you will be paying and when you will be paying. It is an event which will be resulting in uncertain time or uncertain amount depending on court orders. So you disclose the impact of it as part of notes to accounts because you don't have any value which you can estimate as of today. So there is a journey in the life of these contingencies. That contingent liability may turn out to be a provision if the estimate says that you have to pay some amount. So that becomes a provision. When the final order comes, you get to know the actual amount to be paid. So that provision turns out to be a liability. Contingent liabilities are disclosed in the notes to accounts. Contingent liabilities are disclosed in the notes to accounts. Contingent assets, depending on if they are very remote, may not be even disclosed. But if there is an expectation of an asset to be recovered, we may show it initially as part of notes to accounts. And if there is a virtual certainty that we will be receiving that asset, we will be forming it as part of the assets in the books. If there is any restructuring provisions to be made, then depending on the plan of the management, whether they intend to carry out that restructuring provision or redundancies, depending on whatever is the liability of the entity on the basis of the estimates, will be shown as restructuring provisions also as part of IAS 37 provisions, contingent liabilities, and contingent assets. This is all about IAS 37. The next standard is IAS 38. Now, IAS 38 is a standard which is exactly opposite to or in line with IAS 16 property, plant and equipment. The only difference is that the models are same, the accounting is same. The only difference is IAS 16 deals with tangible assets, IAS 38 deals with intangible assets. IAS 38 also has two models, cost model and revaluation model. So the same model which we use for IAS 16 property, plant and equipment will now be used for IAS 38 intangible assets. But here what increases is your research and development expenditure. That intangible assets, there is research happening, there is evaluation, there is a formulation happening, there is a testing happening. can we capitalize that research expenditure or development expenditure, or can we expense it off? So what is the criteria? So for research and development or self-generating assets or self-constructed assets, intangible assets, there is a category known as research and development, R&D expenditure. We need to identify that till what time it is in research phase and when it reaches development phase. All the expenses being incurred in research phase will be forming part of P&L, and the moment it reaches the development phase, any expenditure incurred after it reaches development phase will be forming part of capitalization of the value asset. So when does it happen? When there is an intention to complete the asset, when there is an intention to use the asset, when they have adequate resources, when they believe that it is technically feasible, they have the know-how, they have resources to complete, and will result in future economic benefits going to flow to the entity. When it meets all the criteria, intention to complete, they have resources, they know it is commercially viable, they intend to do it, they have technical feasibility, commercial viability, and when it meets all these conditions, they can begin capitalization from on the day this is identified. When it meets the category of development stage, from that day onwards, they can capitalize all the costs they are incurring. But any expenditure they have expensed till date will not be reversed. If they have expensed any expenditure as part of research expenditure till date and after it meets the development stage criteria, any expenditure after this point can be capitalized, but any expenditure which has previously been recognized as expense cannot be reversed. So do not reverse any research expenditure done. Whatever has gone has gone. You cannot do anything about it. So this is how we deal with research and development expenditures. Now, another basic difference between tangible and intangible assets is among the tangible assets, there is only one asset which doesn't have a defined life. It actually has an infinite life. Land is not depreciated because we believe that land is going to continue to remain the way it is. There's no change, there's no wear and tear except the mining land which is depreciated. Among the intangible assets also, there are assets which are having a defined life, which are having an indefinite life. If they are having a defined life, they are subject to amortization. They can be amortized on the basis of defined number of years. Like a license having a 5 years term, it can be amortized over a period of 5 years term. But if you talk about motion pictures, if we talk about softwares which can continue to run for a foreseeable period, which may continue to give benefits for a longer period, and we cannot define for how long this can give benefit, means the asset has an indefinite life. We do not know for how long this benefit will continue to help these companies to generate revenue for an indefinite period. So till the time it is indefinite and is not amortized, if it is not being amortized, it should be subject to impairment. And indefinite means not defined today, it may get defined in future. The day it gets defined, it will be amortized on the basis of the defined life of an asset. Now there are three cases which are subject to impairment annually regardless of indicators of impairment. One, goodwill is subject to impairment regardless of indicators of impairment annually. Second, intangible assets not yet available for use means which are in the development stage yet. They are being capitalized but not yet available for use because they are being developed, subject to impairment annually regardless of indicators of impairment. Third, intangible assets with indefinite life are subject to impairment testing regardless of indicators of impairment. These three cases are tested for impairment annually regardless of indicators of impairment. If their term gets defined, they will be subject to amortization over the defined period. This is all about IAS 38 intangible assets. The next standard is IAS 40. Now IAS 40 is the standard especially for land and buildings. Land and buildings held for capital appreciation and for renting it out to others. Earlier we were showing these land and buildings as part of our fixed assets, as part of the assets being consumed into the business. So some of the accountants were of the view that this land and building we are not holding for consumption into the business. We plan to hold it for capital appreciation or for renting it out to others. We are not consuming them into the business. So it was decided that they should be shown separately. They should be shown as part of investment properties. Now it was decided that investment properties will have two models, cost model or fair value model. Cost model means we'll continue to follow the accounting which we have been following under IAS 16 property, plant and equipment. There is no change in accounting. The only difference now is that we are classifying that land and building separately, its location, and we are telling the world that this land and building is being held for capital appreciation and renting it out to others. It is not being consumed into the business. So this bifurcation is simply helping the investors to take better informed decisions. The second option is fair value model. Fair value model means you need to remeasure the fair value of the property at the end of each year, and you will take the difference to P&L at the end of each year. Even if you are using cost model, you need to disclose the fair value of the property in the notes to accounts. This is how we deal with fair value model and cost model of investment property. This is only applicable to land and building. If there is any transfer between properties, like if there is any inventory which you plan to now hold it for capital appreciation. You do not intend to sell it. There will be transfer initially at cost. Now, depending on which model you use later, will determine its accounting in subsequent period. It may transfer back as well. That if there is any property, plant, and equipment which is being measured at cost model or evaluation model, depending on the value on the date of transfer becomes the initial cost, and later on, depending on whether it is using cost model or fair value model, will determine its subsequent measurement. So this is all about IAS 40 investment properties. So next standard in line is IAS 41 agriculture. So IAS 41 is the standard dealing with biological assets and agriculture produced till the point of harvest, because after the point of harvest it becomes inventories. So biological asset is any living animal or plant. We determine its value at fair value less cost to sell, because that is living animal or plant, not cut. Living animal also increases in size, reproduces, is able to give milk. Like if there's a cow, it can produce a calf, it can give milk, and it can be slaughtered. It can grow in size, produce, procreate, grow, mature, die. So there is a difference in terms of quantity and quality. Even for a herd of sheep or a cattle of cows, there is a change in terms of quantity as well as quality. So this difference in quality and quantity is measured at the end of each year in terms of fair value less cost to sell, and we define how much of the change is because of the quantity and how much of the change is because of the quality of the change in terms of fair value less cost to sell. So agriculture products like biological assets or agricultural produce at the point of harvest are being measured at fair value less cost to sell. Even the subsequent measurement is at fair value less cost to sell. Agricultural produce at the point of harvest, because after the point of harvest it becomes inventories. The initial value of inventories is derived at fair value less cost to sell. After that, at the end of each year, inventories uses its own principle of lower of cost or NRV. There was an amendment in IAS 41 agriculture that fruit bearing plants like tea bushes or orchards, they are fruit bearing plants. Now, fruit bearing plants will be subject to valuation under IAS 16 property, plant and equipment. Now, if there is a tea bush, the tea bush will be covered under IAS 16 property, plant and equipment, but leaves are considered agricultural produce. They are fruits of leaves. Mango trees will be forming part of IAS 16 property, plant and equipment. Mango fruits are agricultural produce at the point of harvest. After these mangoes are plucked, they will be forming part of inventories. Now we'll need to bifurcate now a mango tree into IAS 2 inventories, IAS 41 agriculture, and IAS 16 property, plant and equipment. The mango tree is IAS 16 property, plant and equipment. Mango fruit till the point of harvest is IAS 41 agriculture. Mango fruit after harvest is IAS 2 inventories. So be careful and read about this information so that you can differentiate between a bearer plant and other agriculture item covered under IAS 41 agriculture. This is all about IAS 41, the standard on agriculture. IFRS 1 first time adoption of IFRS we have already discussed as part of discussion in IAS 1 presentation of financial statements, and when we were discussing IAS 8 accounting policies, changes in accounting estimates and errors, and why this standard is being introduced to avoid application of retrospective effect on all the items which we are going to convert.
Thanks for watching. Do not forget to click the subscribe button and hit the bell icon. Do like, comment and share. See you next time. Subscribe and hit the bell icon.